Most people believe that saving money will make them wealthy. But here's the harsh truth. Relying only on savings is a guaranteed path to losing wealth. Why? Because while your money sleeps in the bank, inflation is working against you.
That's right, it is literally eating your money alive. So today, we're gonna break down the hidden math of why savings alone will never make you rich and what the wealthy do differently. Okay, let's just dive right into it. For generations, we've all been told the same thing, right? Save your money. Save, save, save. But you know what? That advice is dangerously outdated. In today's economy, thinking of your savings account as a way to build wealth, well, it's actually a financial trap.
To really get why, let's start with a really simple question. You see that number your bank gives you, right? 2.5% interest. It feels like you're earning something. But that's only one side of the equation. What's the real cost of living increase that's constantly pushing back against you?
And here it is. The answer is that the average inflation rate is hovering around 4.2%. I mean, just look at this chart. That taller bar, inflation, is just towering over the tiny little bar representing your savings interest. That gap you see right there, that's where your wealth just disappears. So this is the number that really matters. When you subtract inflation from your interest rate, you get your real return. And right now, it's negative 1.7%. This isn't just about failing to grow your money. This means your cash is actively losing its ability to buy things year after year.
Now let's really get into the numbers here, because this seemingly small negative return, well, it leads to massive wealth destruction over time. This is the hidden math that quietly keeps savers from ever getting ahead.
This table just breaks it down perfectly. Your bank statement, it shows you the nominal return. That 2.5% looks pretty good. It's positive. But the real return, which is what your money can actually buy, tells the true story. You are losing money. Even a fixed deposit at 6.5% is just barely keeping your head above water. The only option on this list that's actually building real wealth is the one that completely crushes inflation: equity investments.
We've all heard about the magic of compound interest, haven't we? But here's the twist nobody talks about. It is a double-edged sword. When your returns are negative, inflation creates this thing called negative compounding. It's not just chipping away at your initial money, it's compounding your losses in purchasing power over and over again.
And this right here, this slide shows the absolutely devastating result of that negative compounding. After 25 years, your 1 lakh rupees in savings might look like it's grown to 1,85,000. But in terms of what you can actually go out and buy with it, it's shrunk to just 66,000. You've been saving diligently only to become poorer. It's crazy.
So if saving is a losing game, what's the alternative? Well, this brings us to the most important shift you can possibly make. It's moving from a saver's mindset to an investor's mindset. It's about fundamentally changing the questions you ask yourself about money. You see, the saver is always on defense, always thinking about cutting costs, clipping coupons, just trying not to lose. But the investor, they're focused on offense. They're thinking about growth, about expanding their ability to earn. They see money not as something to be hoarded and protected, but as a tool to be put to work. And this quote just captures the difference perfectly. A saver meticulously counts their seeds, feeling secure as the little pile grows. But an investor, they plant those seeds, taking a calculated risk today for a whole forest of opportunity tomorrow. Wealth comes from the planting, not the counting. Okay, so if the wealthy are out there planting trees, where exactly are they planting them? Let's actually look at the data. This is the real secret of asset allocation. Where you put your money is so much more important than how much you can squirrel away. Now, this is really interesting. What you should notice here is what's practically missing. Look at that tiny sliver for cash, just 10%. The vast majority of their wealth is in assets that are designed to grow, things like real estate and other alternative investments. They keep the absolute bare minimum in cash because they know cash is a depreciating asset. See, the goal isn't just to have a big pile of money, it's to own assets that generate more money for you. The average millionaire has 7 streams of income. They're not just trading their time for a salary. Their assets are working for them 24/7, generating income from real estate, stocks, and businesses.
I know this might all seem a little overwhelming, but the strategy is actually pretty simple when you break it down. So let's create a clear 3-pillar playbook that you can start using today to make that shift from being a saver to a real wealth builder.
These are the 3 core principles. It's that simple. First, you have to aim for returns that absolutely crush inflation. Second, you have to let time and compounding work for you, not against you. And third, you've got to do it smartly by diversifying your investments. Okay, Pillar 1 is all about setting the right target. The goal isn't just to squeak by inflation's 4.2%, it's to generate significant, real growth. And historically, asset classes like stocks and real estate have delivered average returns in that 8–12% range. Now that's the kind of growth that builds lasting wealth. And this is where Pillar 2 really comes to life. Just look at the staggering difference that time and higher returns make. We're talking about the exact same monthly contribution, 10,000 rupees, leading to 2 completely different futures. Putting into equities harnesses the power of compounding, creating over 56 lakhs in extra real wealth. That is the time value of money right there in action. And finally, Pillar 3 is about being smart and managing your risk. You know the old saying, don't put all your eggs in one basket. By spreading your investments across different kinds of assets, stocks, bonds, mutual funds, maybe some real estate, you protect yourself from the ups and downs of any single market, and you create a much stronger, more resilient portfolio.
And look, if you're still not convinced, just think about the cost of doing nothing. That safe 1 lakh rupees in your savings account isn't just losing a little bit to inflation each year. The real cost, what we call the opportunity cost, is the 5.4 lakhs in real wealth that it could have become. That's the actual price you pay for playing it too safe.
So what are the concrete first steps you can take? It's pretty simple. First, figure out your emergency fund. That's about 3 to 6 months of your essential expenses, and keep that in a savings account. Then invest everything else. You can start systematically with mutual fund SIPs, explore real estate when you're ready, and please never forget the highest return investment of all, yourself. Your skills are your greatest income-generating asset.
And that really brings us to the final question, the one for you to think about. When you look at your own finances, what are you doing? Are you spending all your energy counting the seeds in your savings account, or are you using them to plant trees that will give you financial shade for years and years to come?
Saving alone will never make you wealthy. Inflation makes sure of that. The rich know this. Money is a tool, not a trophy. Put it to work in assets that grow, and let compound interest work for you, not against you. Don't just save. Invest, diversify, and build real wealth. Your future self will thank you.